Welcome, you're on the Fringe Show. I'm your host, Tatiana Zalon, and I go live every Friday, 2 p.m. Dubai time. This is a re-recorded show because last Friday when I went live, the internet connection was very unstable, so I'm re-recording it once again. Why do you need to be on the Fringe Show? Because the Fringe helps you to navigate the rapidly changing world and increase the odds of your success. Here we discuss technology, startups, and mental models of successful people so that you too can take advantage of the opportunities in the new digital world. This is my 16th show, and today we will be discussing central bank digital currencies. It's a financial innovation and which may potentially have impact of many people worldwide, on the billions of people worldwide. So we are going to discuss what are CBDCs, how they work, what are the risks, which countries are working on central bank digital currencies or CBDCs, who is implementing that, and also what they mean for ordinary folks like you and me. Before we go any further, a bit of a disclaimer. As usual, I'm not your financial advisor. I don't have a financial background, and this show is for informational and educational purposes only. I will be using a lot of quotes because I don't want to misquote very important people, what central bankers are saying, what other technologies are saying about the future of central bank digital currencies. So let's get started. At the beginning, it can be a little bit technical, and we will be talking also about economic risks and technical risks. However, the really juicy, interesting parts are at the end of that. But in order to get to the end, I need to explain to you how CBDCs really work. Now, what are CBDCs, central bank digital currencies? They're cousins to cryptocurrencies and stable coins in a way. Cryptocurrencies and stable coins like Tether and USDC and Facebook's Diem now are private money. A CBDC, or central bank digital currency, is a digital or digitalized rather liability of a central bank. These are kind of public money. Central bank digital currencies can be seen also as almost like a digital extension of the existing form of central bank money, particularly cash, bills and coins, and central bank settlement accounts. How many countries are now working on CBDCs? More than 100 countries. And according to Kristalina Georgieva, she's the head of IMF, a major consideration is whether central bank digital currencies can serve as a means of exchange, and that means of exchange can be trusted by the public. Other policymakers also need to answer the question of if CBDCs can contribute to domestic economic stability and how they will fit within the broader regulatory framework, particularly introduced by organizations like the Bank for International Settlements, which is the central bank of the central banks. She also expands on cryptocurrencies, decentralized cryptocurrencies versus central bank digital currencies. She views digital currencies issued by central banks as the most reliable form of digital money, and she's finding it really hard to think about cryptocurrency as money. She's saying that de facto assets like Bitcoin are not backed by assets that hold their value stable and can rise or fall sharply. And so she's insisting that in the history of money, it is difficult to think about them as money. She's referring to cryptocurrencies, decentralized ones. Now, let's have a look at why do we need CBDCs? Why are central bankers are pushing for CBDCs? Well, one of the reasons is that the way we use money in payments are changing. The use of cash has been declining very steadily over the years, and I think that during the pandemic, the use of cash has declined even further. If we look at some data from, say, the UK, then back in 2006, you would have something like 63% of all transactions using cash. Now it's well under 30%. So you can see the scale of things. According to the Bank of England, and I'm sure that other central bankers are also thinking about the opportunities for the bank's objectives in those sorts of terms, why do we need CBDCs? Supporting a resilient payments landscape, that's straight from the document, avoiding the risks of new form of private money creation. They're clearly scared of cryptocurrencies, decentralized ones like Bitcoin and Ethereum, supporting competition, efficiency, and innovation in payments, meeting future payment needs in a digital economy, improving the availability and usability of central bank money, addressing the consequences of a decline in cash, as we've just stated, and as a building block for better cross-border payments. And who would deny that? Cross-border payments in particular are very, very inefficient. How will this work from a very high-level perspective? How do you design a central bank digital currency? At the very top, you have a central bank core ledger. Then there is a layer of APIs, application programming interfaces. That's where the payment providers, private payment providers, big tech companies, will interface with the central bank. And then this is us. So kind of 4 layers according to the Bank of England, at least. Us users here at the bottom, then payment providers. There will be something like Stripe or PayPal. Then we have APIs of these central providers and the core ledger of the central bank at the very, very top. As you can see, and that design, and it's not the only design, but it's probably one of the most popular and accepted designs, is that there is no role for commercial banks here. So mutual funds, commercial banks, they all go. Now, what's the technology behind the central bank's digital currencies? There's a trade-off here between different designs. On the one hand, we have a conventional centralized technology, central servers and databases. On the other hand, we have DLT, distributed ledger technology or blockchain. DLT, according to the central bankers, has some potentially very useful innovations. Now, bear in mind that this is permissioned DLT, in which a network of centralized entities will validate the ledger. It's not as decentralized as, say, Bitcoin or Ethereum. DLTs will be updated in a decentralized manner, and in many DLT-based systems, this ledger is jointly managed by different entities who do not necessarily trust each other, and they will independently verify all these transactions. So we have 2 interesting features here with DLT, distribution and decentralization, and that will ensure a lot more of resiliency and availability on the positive side. But on the negative side, there will be a negative impact on things like performance, privacy, and security, because there's one central point of failure. CBDCs may be able also to provide the programmable money through smart contracts. And smart contracts, as we discussed in my previous shows, it's a contract that says if something happens, then this will happen. There will be, of course, a range of options of how this all will be delivered. And it can be, they're saying, can also work on public networks, other networks like Ethereum. And that feature of programmability and using smart contracts is very, very important, and we will come back to it later on. So remember this programmability of central bank digital currencies. Now let's have a look at the risks, at the economic risks first, and then at some of the other technical risks, for example. The CBDCs will clearly challenge the role of conventional commercial banks, depending on, of course, on how the central bank will implement and will work with these private intermediaries. But such a threat could seriously corrupt and interrupt even the normal functioning of any economy of the nation's financial infrastructure. If a CBDC is issued by another country, which can become dominant, then other nations could lose control over the national sovereignty, and and there are very clear indications that this is exactly what China is trying to do with their digital yuan. They're trying to become a financial superpower. And if a CBDC becomes reserve currency, then international trade could be destabilized because of the necessary adjustments that need to be made in order for this to function. Not finally, but one of the other considerations is that many countries, particularly in emerging markets, developing economies, they already know the phenomenon of dollarization, where households and even businesses, they will transact and use a foreign currency for all their daily transactions and financial contracts even. And this is because they simply don't trust their financial intermediaries, they don't trust governments and banks. So could CBDCs promote such kind of digital dollarization or its equivalent in CBDCs? It's highly likely it's an economic risk. Depending on the architecture of central bank digital currencies, they may also facilitate the use of crypto by governments, groups, and individuals, which may be engaged in some kind of illegal activities. There are, of course, other risks which are technical and non-technical. There is also a risk of extreme intrusion into personal privacy, because governments might use CBDCs to more easily control and monitor their citizens' assets and spending. We, with our digital footprints, we use and leave troves of data behind us, but we're faced with severe information asymmetries with users. We don't know how or where these data are being collected and for what purpose and how it's being used. Cash, on the other hand, has value for consumers because it's truly anonymous and protecting individuals' privacy. Another risk is if CBDCs are centralized, then there are security concerns, because banks are really major targets for cyber criminals, because they know, cyber criminals, that there is one central point of failure, and this is what they're always targeting. And finally, there may be some issues and weaknesses with underlying programming, lack of interoperability, and that will have some performance problems for CBDCs. Now, let's have a look at how various countries are trying to implement CBDCs. And we'll start with China, because China perhaps is significantly further on this journey than any other country. China began working on its digital yuan back in 2014, and it's already conducted a series of pilot programs to test its viability. Its widespread adoption of the CBDC, particularly for cross-border transactions, will help China, or might help China, to become a global financial superpower, and sometimes, maybe very likely, threatening the role of the US dollar as the reserve currency at the moment. And the People's Bank of China, which is the central bank, is very, very clear that digital cash is not limited to domestic transactions only. And as far as that design goes, the digital yuan is going to be a cash-like liability of the central bank, available to the general public and also to foreign visitors to China, and that will be done through account-based interfaces. There are a couple of government officials that are discussing how this is going to be implemented and what's the future. And in particular, one of them, who is now director of the Science and Technology Supervision Bureau of the China Securities Regulatory Commission, says that CBDCs shouldn't attempt to be just a digital form of physical cash, but should also incorporate smart contracts functionality. So they're very clear, very transparent about that. And this is all done under the guise of what they call financial inclusion. They say lead operations can enable the CBDC to better benefit groups without bank accounts and achieve financial inclusion. And he's saying also that in theory, via this two-tier approach, a digital yuan or the digital dollar could sit on Ethereum's network, on that of Facebook's Diem, which is formerly Libra, by the way. That would mean central banks could provide CBDCs directly to users without needing intermediaries. So they're very, very open about what's going on. With the Bank of England, it's not as advanced as China. In 2021 in April, so at the beginning of this year, they announced that they're setting up a central bank digital currency task force to coordinate the exploration of potential of CBDC for the UK market. And they're saying that it would be a new form of digital money. And at least in this statement, they announced that it will exist alongside with cash and bank deposit rather than replacing them. Who knows? But this is what they said back in April. And now the government promised also that they will be engaging a lot of stakeholders for various consultations for the benefits of risks and the practicalities of implementing this. In the US, they're, of course, also considering stablecoin, a Fed coin. The Federal Reserve Board Chair Jerome Powell was very clear about it. They were carefully monitoring and adapting to the technological innovations that are now transforming the world of finance, the world of payments and banking. And some proponents, according to him, of the Fed coin argue that it would create a kind of a parallel system where the Fed would be able to directly dispense Fed coins to the public using kind of an idea of helicopter money finally achieved. It could also offer more efficient avenue for distributing welfare and financial aid, and it could be made a tool to make cash obsolete as well. But within the Fed, probably the most major motivation is that fear, if they don't create this central bank digital currency, then it could potentially threaten the US dollar dominance currently as the reserve currency in the world. So in this respect, it's like any other technological arms race, this time with China mainly. There is another interesting project that's going on, and Cointelegraph announced about this project back in September 2021. It's called Project Dunbar, where the central banks of Australia, Singapore, Malaysia, and South Africa got together and announced this joint initiative to trial international settlements using central bank digital currencies. This initiative is dubbed Project Dunbar, and it will prototype shared platforms which will enable direct transfers between institutions using digital currencies. There have been pilots running, and these pilot programs will inform, according to them, the development of global and regional platforms and will support the G20's roadmap for improving cross-border payments. This project is run in partnership with the Bank of International Settlements, of course. Who else? There will be multiple platforms using different distributed ledger technology platforms and explore different designs. So they're not really settled on the design yet. It's not clear on what exactly it will look like. Visa also wants to get a part of this action, and according to one of their senior officials who is head of cryptocurrency projects, they point out that CBDC is one of the most important trends for the future of money and payments over the next decade. And they also add that regardless of anyone's personal view or whether it's good or bad, the reality is that global interest in it is not going away. CBDCs will have major implications for privacy, monetary sovereignty, geopolitics, and financial inclusion, as well as global adoption of crypto dollars and Bitcoin. I'm not sure why he thinks that Bitcoin, it will help the adoption of Bitcoin if we introduce CBDCs. Central bankers don't love Bitcoin at all. And Visa, they're also saying that they want to build a universal hub to exchange stable coins and central bank digital currencies. Now, And this is probably where it gets really, really interesting. And I must thank Catherine Austin-Fitz from Solari Report. I'm a subscriber to her report. She's an ex-investment banker and ex-government official. And also to Richard Werner, who is an academic, a finance professor. Every year, there is a symposium of central banks that happens every August, and 2019 was no exception. And please pay attention to the dates. On 22nd of August, that happened in 2019. The central bankers got together for a symposium, and that time BlackRock was also invited. BlackRock is one of the largest investment banks and private equity firms in the whole universe. They own literally half of the universe. They came up with a document which is called Dealing with the Next Downturn, from Unconventional Monetary Policy to Unprecedented Policy Coordination. That's the name of the report. And I'm just looking at the summary of this report that I've got here. There are many important points, but I'll just read out a couple of them. Unprecedented policies will be needed to respond to the next economic downturn. So in 2019, August, they're predicting an economic downturn. And this is what they're saying as well. An unprecedented response is needed when monetary policy is exhausted and fiscal policy alone is not enough. That response will likely involve going direct. These are the key words, going direct. Going direct means the central bank finding ways to get central bank money directly into the hands of public and private sector spenders. So the translation of that is as follows. So far, at least in the West, and at least in countries, in big countries like the US, the Treasury and government were looking after fiscal policy, while the central bank and the Feds, they were very, very clear that they want to be separated. They don't want to be involved in fiscal policy, but only in the monetary policy. What we're seeing now, what going direct actually means, is that central banks will be overlooking and monitoring both monetary policy and fiscal policy. What are the mechanisms for doing this? There are two steps. One is digital cash, and we've been using digital cash for decades now. There's nothing new here. And the other one, the second one, is central bank digital currencies. According to Fitz and Professor Werner, these are digital transaction systems. It's like a credit in a company store or a current account with a central bank. It's a mechanism, according to them, for financial control. And according to Fitz, it's taxation without representation. So it's truly a fundamental re-engineering of the entire economy, where central banks are now being able to exercise not just monetary policy, but fiscal policy as well. What else can they do? Well, they can be, really central banks will be able to regulate our consumer behavior, because they will have all the data on real-time spending. That will go really, really well with universal banking, basic income, UBI, which will happen probably because of automation. And it can be combined with a social credit system, just like in China. There was a recent Philly Fed report, and they also warned that a CBDC could also destabilize the financial system if everybody were to pull out their digital dollars from markets, mutual funds, and banks alike. It will clearly make all the commercial banks and mutual funds obsolete under the system. And what's the effect on decentralized crypto? We don't really know yet, but Gary Gensler, who's a very powerful person, he's the head of the SEC, the Securities and Exchange Commission. He used to work on the CBDC project with MIT just recently, and he's not a friend of decentralized Bitcoin and other decentralized crypto. And regulators have started to move in. In one of my previous shows, we talked about how regulators are really crushing on some exchanges. Some exchanges have been set up according to all these regulations, and they're still cracking on them. And they're cracking on crypto. They're forbidding this and forbidding that, and so on. And this is one also very, very important point. Remember how I mentioned this programmable digital currency and the use of smart contracts several times in this show. And this code word, programmable money, means that central banks are in a position to control how we spend our money. And that's a direct quote, and it's all on YouTube. You can go and check it out. It's from Augustin Carstens, who is the head of the BIS, the Bank of International Settlements, and he made this statement in October 2020. There is a huge difference in how CBDC and cash are used. In cash, we don't know, for example, who is using a $100 bill today, who is using a 1,000 peso bill today. The key difference with the CBDC is that the central bank will have absolute control on the rules and regulations that will determine the use of that expression of central bank liability, and they have the technology to enforce that. They're very transparent and very clear about what they want to do. And, my hat off, finally, some words of clarity from a central banker. He's quite open about it, telling the truth. And then a little bit later, and that's there is an article in The Telegraph in June 2021. They're quoting Deputy Director of the Bank of England, talking about digital cash, how it can be programmed to ensure that it is only spent on essentials or goods which an employer or government deems to be sensible. And this is a direct quote. You could introduce programmability. There could be some socially beneficial outcomes from that, preventing activity which is seen to be socially harmful in some way. You could think of smart contracts in which the money could be programmed and to be released only if something happened. Translation. That is, it will work perfectly with universal basic income or other forms of any state benefits. You can also combine it with other financial products like carbon credit cards. Carbon credit cards are already happening. MasterCard just recently announced on Twitter that they're partnering with partners like Barclays and others to launch a climate fintech cards and payment challenge. And that's for fintech startups who want to co-create the future of digital payments with us and help tackle climate change. So if the central bank doesn't like the way you drive, what kind of petrol you use, or you've spent too much on your car or on your petrol, then it will be a sanction against you. They can just simply turn off the drain. So what are the key takeaways here? For us, for you and me, ordinary folks, CBDC is the financial innovation or financial re-engineering of the economy. You decide. What does it mean for the main street? Well, cash will probably disappear. They will be collecting even more data on us. They will be empowering big tech even further. They will be getting rid of smaller banks, of credit unions, of mutual funds, because they're intermediaries, and according to central bankers, we don't need them. And it's control of our spending with programmable money. So guys, how do you like this scenario? Please let me know. Thank you for joining. I shall see you on the Fringe show next Friday, 2 p.m. Dubai time. Thank you again.